Well, good morning, everyone. I haven't been around the last few days. I was in Miami with my family enjoying Christmas holidays. And you might have seen a video and a webinar that I did from Miami. It was beautiful. We were right at the harbor. We saw a bunch of boats. It was really a great holiday to spend with the family. But I'm back. And I'm always home for New Year's. I don't like to travel New Year's Eve. Too many people, too many trains, planes, and automobiles, if you will. That was an amazing movie. That was the movie I watched last New Year's Eve, actually. Planes, trains, and automobiles. All right, let's get back into the market. Jobless claims came out about 40 minutes ago. Market's going to open in about 20 minutes or so, 18 minutes. The number was 222, right smack in line of expectations. We've got a holiday week, not much going on. Bond market, I'm expecting to see a little as soon as we get to this is the TLT. The TLT is an ETF that tracks the long bond. So if you look at the 10-year bond futures, if you look at the 30-year bond futures, it'll track it almost tick for tick. And it allows you to trade bonds with regular stockbrokers. So if you look at the bond market, let me show you a weekly chart. We've got a strong descending triangle here. Let me show you here. Look at this here. Oops, excuse me. Tough crowd. Very sensitive software here. Oops. I should probably learn how to use it first, right? Before I use it. Anyhow, you could see here, I made the line a little too big, but you could see here the triangle. And I think we're going to be bouncing up here, congesting a little bit here, maybe another next few days, and then we're going to break lower. Now, this is really important because this is telling us that the markets are ready to raise rates, at least long-term rates. And even though the Fed has been lowering rates, which means bonds should be moving higher, remember there's an inverse correlation between bonds and interest rates. I'm not seeing it at all right now, and either has the market. The market basically has given us a very clear signal that interest rates are going higher. Now, things can change. Let's say China and US get back to trouble, bonds will start rising. But if everything goes according to plan, bonds should be coming down and interest rates should be starting to come up, at least the long-term fluctuations. Short-term fluctuations we may see over the next 6 months. I think the Fed is going to start raising rates, the short-term rate, if China and US continue to work out their differences, and if employment and economic data looks stable, and it looks really, really stable right now. It looks really good. I mean, look at this jobless report, 222. This is a really good number, right in line of estimates. Unemployment's at a 50-year low. GDP's at 2.1%, above 2%, 2.1% is our target. So things are looking good. The only thing I'm unhappy about is if bonds start coming down, if bonds come down and interest rates start going up, we may see a little cool off in the stock market. Talking about the stock market, look at this S&P. I don't know how many ways I could show how overbought it is. I mean, RSI is at 80, 79, almost 80. We've got crazy divergence here. Not crazy anymore, but I can't draw these things to save my life. Let's see here. Vertical line. Here we go. Vertical line. Maybe I could fake my way through it. It's a trend line. There we go. Let's draw a trend line. You see how this goes up? Maybe one of these days I'll actually learn how to use this the right way. And this is moving down. You could see it right here. So you could see the divergence, the level of divergence. The oscillators are moving lower and price action is moving higher. And with this overbought level, it's not really good at all. As a matter of fact, and I showed you this last week, but I'm going to show it to you again because it's just not getting any lower, and it's gonna correct. Now again, I'm not looking for a huge correction. I'm looking for very little downside just to get us over the hump. Oh wow, whew, wow. 90%. This may be the highest level we've seen, 50-day. This is the number of stocks in the NASDAQ 100 out of 100 stocks. 90% of stocks, so 90 stocks out of 100 stocks are trading above the 50-day moving average. I want to show you this. I think this may be the highest level we've ever seen. Let's take a look here. Wow. Let's see. Have we gone? Let's look at 10 years. Wow. We may be near or at the highest momentum levels in over the last 20 years. I believe, no, right here. March 2000, in 10 years. Look at that. And look at that. It went to as high as 92. We're there, right? 90, 90. This is it. I mean, we've gone above this level one time in July 2009, and then we came off. We've gone to this level, these levels, these nosebleed levels. Let's see here. 1, 2, 3, 4, 5, 6 times. And if you're talking about as high as we are now, look at this. Let's go there. Let's go all the way to the top here. Look at that. One time. 2009, a decade ago. We haven't reached these momentum levels in a decade. Now, it doesn't mean the market's set to go into a bearish phase. Not at all. It just means we need to correct. As soon as 50% of stocks are above the 50-day moving average instead of 90, wow, we're going to cool off. We're going to cool off, and it looks to me, if you were to look at the SPY, let me just give you an idea of where I think we're going to come off to. Most likely, the odds are we're just going to go up to about the 256 or the 25,600 level if you're trading the E-mini futures. If you're trading, let me show you the E-minis. I know some of you trade the E-minis, so I want to make sure. Probably going to go right up to about the 3,100 level, give or take. But anyhow, I expect us to move back to the 50-day line before moving higher because, I mean, look at this. Over 90% of stocks in the NASDAQ 100 are trading above the 50-day moving average. That's insane. That's straight up insane. All right, I think I've said enough. Definitely need a mild correction. Not a strong, crazy correction, but a mild correction. Also, I want to show you something else. I want to talk about one more topic. This is the percentage of stocks in the NASDAQ trading above relative strength levels. And I wanted to show you, we've got Tiffany's, we've got Apple, Best Buys, and Nordstrom's. Doesn't look like we have enough to have in a target. We may have a New Year's Eve rally, but with the level of the level that the market is stretched out right now, I just don't see it. I mean, this is insane right here. First time in 10 years. First time in 10 years. Anyways, I hope that was great. Folks, remember something. I'm doing Saturday in the morning, Eastern time. I think it's 11:30. I'm not sure exactly on the time. I'm doing a class. There's no cost. I'm going to talk about what we can expect in 2020. I'm going to give you all the predictions, the best sectors to be in, the worst sector to be in, where I think the stock market's going to go, where I think the stock market's not going to go, where the bond market's going to go. You don't want to miss this out. Keep your eye on your inbox. You're going to get an email with access instructions. It's happening this Saturday. You don't want to miss out. Turning Point 2020, be there. Don't miss out. Keep your eye on your inbox.